We are tackling a critical topic for the Enrolled Agent Part 2 exam, partnership allocations under Internal Revenue Code Section 704B and the Substantial Economic Effect Test. The core principle you must master is that while partners can agree to split profits and losses any way they like, the IRS will only respect these special allocations if they have a real economic impact. If they don't, the allocation is ignored, and items are reallocated based on each partner's interest in the partnership, often called PIP. The exam will test your knowledge of the three-part safe harbor test for establishing substantial economic effect. Think of these three rules as the pillars that hold up a valid special allocation. First, the partnership must properly maintain capital accounts for each partner as detailed in the regulations. This means capital accounts go up with contributions and income allocations, and they go down with distributions and loss allocations. An exam question might describe a scenario where distributions are made that don't affect capital accounts. This is a clear red flag that the first test is failed. Second, upon liquidation of the partnership, all proceeds must be distributed according to the partner's positive capital account balances. This rule connects the tax accounting to the actual cash. For example, if partner A has a final capital account of $60,000 and partner B has $40,000, they must receive distributions in that exact amount. The exam might present a situation where the partnership agreement calls for a 50-50 liquidation split, even though the capital accounts are 60-40. This allocation would fail the second test. The third and most heavily tested pillar is the deficit restoration obligation, or DRO. This means if a partner has a negative capital account, when the partnership liquidates, they are legally required to contribute cash to bring that account back to zero. This makes losses real. Imagine a partner is allocated a $100,000 loss, driving their capital account to negative $70,000. If they have a DRO, they are on the hook for that $70,000. An exam trap is to present a limited partner or an LLC member who is allocated a large loss but whose liability is limited and has no DRO. That allocation lacks economic effect because the partner isn't bearing the real economic burden of the loss beyond their initial investment. Let's use a classic exam scenario. The AB partnership allocates all depreciation deductions to partner B, who is in a high tax bracket. Partner A is in a low tax bracket. The partnership generates a $50,000 depreciation loss. B's capital account goes negative. The question asks if the allocation is valid. Your first thought should be to check for a DRO. If the facts state that B is not required to restore a deficit capital account, the allocation fails. The $50,000 loss will be reallocated between A and B according to their interests in the partnership. A simple way to remember the three core requirements is the mnemonic CLD. C for capital accounts, L for liquidation, and D for deficit restoration obligation. If an allocation has CLD, it has substantial economic effect. Be careful with wording like allocations intended to reduce the total tax liability of the partners. This points to a failure of the separate substantiality part of the test, which invalidates tax game playing even if the mechanical rules are met. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.